It's quite alarming to see a sharp drop in our stock and mutual fund portfolio. Foreign funds are the culprits. These funds have been offloading Indian stocks at an unprecedented rate, though DIIs are trying to counter it. Foreign fund managers, from New York to Singapore, significantly impact your stocks and mutual fund returns. Their decisions can sway the market in ways that are sometimes hard to predict. This year, over 1 lakh crore worth of Indian stocks in under 2 months have been sold. Since October last year, they have sold over 2 lakh crore, higher than the record 1.7 lakh crore net inflow in 2023. So what's driving this massive sell-off? We need to know the factors at play to help us make sense of the current market scenario. First, India's current earnings growth and demand just aren't picking up. Companies are struggling to meet the high expectations set by investors. Also, the falling rupee and returns in dollar terms look even worse. When the rupee depreciates, the value of investments in dollar terms decreases, making Indian stocks less attractive to foreign investors. Second, Trump's election win has sparked global turmoil. Political uncertainty often leads to market volatility, and investors tend to move their money to safer assets. Some foreign fund clients are pulling money from emerging market schemes, pushing funds to sell Indian stocks. Why India? Because it's seen as a high-risk market in times of global uncertainty. The Indian market had a significant run-up post-pandemic, and now investors are looking to book profits. Even if India is a hot investment spot, foreign funds are focusing back on the US, as the US market is seen as more stable and offers better returns in the current environment. High US bond yields and a strong dollar mean less incentive to risk emerging markets, especially with India's high valuations. When US bond yields are high, they offer a safer and more attractive return compared to riskier emerging markets. Also, the capital gains tax has softened the Indian equity returns further. Higher taxes on capital gains can deter investors from holding onto their stocks for longer periods. What could stop the selling and reverse this trend and bring stability back to Indian stock market? Signs of demand picking up, better earnings outlook, and reasonable valuations. If companies start showing better earnings and the market valuations become more attractive, it could attract investors back. GDP growth above 6 to 7%. Macroeconomic stability, inflation control, and investor-friendly policies would also help. A stable and growing economy is always a positive sign for investors. While foreign funds influence the market, their stake in Indian stocks is relatively small in global context. Foreign investors now own about $800 billion worth of Indian stocks, which is roughly 16% of India's market cap, which used to be earlier as high as 24%. If the market corrects further, some funds might slow down selling as they create buying opportunities, seeing value in certain stocks. Understanding these underlying factors can help you navigate these turbulent times.